Hey, John, how's it going today?
Hey, Pete, how are you? Good morning. Happy Friday to you.
Happy Friday. So, a lot to talk about today. Today, we're going to actually break down the two different trades, one from an options perspective, one from a stocks perspective, to see that how the same trade can play out drastically differently and why probably most people should consider implementing both at the right time, meaning stocks versus options. What do you think about that?
That sounds fantastic. I think there's so many ways to dissect, the markets and so many ways to skin a cat, so to speak. So let's jump into it. I'm excited to go over these examples. They seem really, it's really cool to watch this stuff in action. So I'm ready.
So both of these ideas come from our pre-market game plan. We have a meeting every day at 8:30 in the morning where members of the community can post their ideas. And I just want to give like a mentoring tip to everybody who's out there. One of the things when I had my trading firm, one of the biggest things that would catapult somebody's experience very, very quickly was being able to basically build an argument or kind of justify why they should be in that trade. And when I had my firm, I made everybody stand up in the room, and they basically had to be prepared with that. And if you weren't ready, you weren't trading that day. I was sending it home. So the point that was the most interesting was how off the mark new traders thought were good ideas, but actually weren't. And the only way you can have that conversation is kind of going back and forth to actually say, okay, tell me what you see, and now I'll tell you what I see. And then every day you kind of build that muscle of developing good ideas. So we're going to take a look at two ideas from the community today. One of them is Broadcom, and the other one is Meta. So let's actually start out first looking at Broadcom, which I've been trading so long. The symbol used to be BRCM. It's not anymore. It's AVGO back in the day in 2000.
You're dating yourself, Pete.
Exactly. So let's actually give it a longer term view here to see where the stock is. We're actually not too far from all-time highs. The most recent resistance over here is the 185-ish level, like literally right over here. Now, the big thing that pops out for me, just to kind of like, we can kind of go back and forth, is looking at, obviously earnings came out, so we could kind of pop earnings in there, and they were actually kind of disappointing, but you see the line we drew here, it actually recovered very quickly within 2 days. But now we're talking about something that a lot of people, I think retail traders probably don't do this enough, which is talking about tying up capital.
Right.
And I'll give the perspective from the equity trader side of things, which is prop traders are obsessed with having enough capital. And I don't know that retail traders learn this soon enough, where if I'm going to tie up money, I want there to be profit potential immediately. In other words, I want my money moving to the next move, to the next move, to the next move, because I just don't want it sitting there. And obviously the conversation today, options, you can have a lot more options even if something doesn't move. But in this particular situation, we're not that far from all-time highs, but the stock has basically been stuck in this window for the better part of 4 months. So We talk about entries, we talk about profit potential, we talk about how much money is stacked into the idea at this particular moment. And right now, everything that we do builds up to what does that mean for the initial position size, and what is the expectation for follow-through? So we can clearly see here the stock's been stuck in a box. At this level, we have a couple of, like a minor resistance levels hitting all-time highs. But the bottom line is that's been the right price through a couple of different earnings reports. It hasn't been able to get out of there. So for me on the equity side, an $169 stock, I'm not going to tie up a lot of capital until somebody has enough force to get it out of this box to make it justify putting on a new trade here. So it's kind of an advanced thing. And what we'd normally be doing when I had my firm is we would call this a feeler position, where because the resistance is so obvious, we wouldn't have any kind of size really initiating a position. We'd be putting on probably 1/10 of what we were looking for just outside of this box, looking for it to get through there. And then we'd actually kind of read the tape before we started to build a position. So we're kind of starting out with one that's really a non-trade. But the point that I want to get across is recognizing capital allocation and minimizing when you have too much money allocated to an idea that does not have a clear room to go is very important.
Yeah, absolutely. I mean, this one looks like it wants to break out, but we're not sure yet. So putting a feeler position is a perfectly justifiable thing to do at this moment. You also have to think in terms of where are we in the market. We're kind of at a triple top on the S&P 500. We just broke to all-time highs, but we're backing off today. So you can see that, and the NASDAQ obviously is more correlated to Broadcom and Meta to some degree. So you're looking there that, you know, the NASDAQ has not made all-time highs like the S&P did.
Yep.
So you do not have the NASDAQ really behind you on a trade like this. So as a new trader, you get so tunnel vision with the actual stock itself. You don't realize that, hey, is the market behind me? Do I have the market and the sector and the space itself behind me? And right now, the answer is not really. I mean, the market's somewhat bullish because of what the Fed did yesterday, but there is a little bit of apprehension going on today. So that being said, a feeler position to the upside makes perfect sense on the stock side. On the option side, what I'm seeing there is a whole bunch of kind of sideways. So what I think, you know, if I think the likely outcome is up to sideways, you know, I could profit from a potential sideways move while I'm waiting for a potential move to the upside, and that's the position that I would take. I would look in a situation like Broadcom right now. I would look to something on the credit side. Volatility remains somewhat elevated. We're close to 18 on the VIX. You know, even though, you know, actually it's 16 now, we fell off from yesterday, but basically it's elevated compared to where it was 2 weeks ago, like, I mean, or a month ago to all-time lows. So it's not like super high, but it's not super low either. So I would look to try to do some sort of two-leg strategy for that reason. When you have a slightly elevated volatility, it always makes sense to look towards some sort of spread. And that's the kind of trade that I would put on. Looking right now at where it's currently trading, I would look to start by saying, well, how low can it possibly go, or how high can it possibly go, and potentially do some sort of iron condor, which is basically a double credit spread on a trade like that. So I would pick the resistance point of maybe 180 or something like that. And I would, or maybe even once, if I want to be more aggressive, maybe 175, I would sell call options, you know, maybe just going out about a week. Because I might not expect it to get that high in the next week or so. I might expect it maybe to drift sideways, maybe test the lows first, and so on and so forth. So basically, that's kind of, you know, that's kind of what's going on. That's kind of how I would treat the upside. On the downside, I would sell some puts at support. Maybe, you know, I'm looking now at the price, maybe at the 155 or 150 level, and then buy puts underneath it for protection. I wouldn't necessarily put them on at the same time. I would pick, you know, when Broadcom is trading lower, I would put the puts on to get a better premium. And if Broadcom was trading up, maybe up 1 or 2%, I would look to put the calls on. And I would look to stay in that trade about 2 weeks or so.
All right, let's hop on over to Meta, giving everybody a kind of a lightning round, to use somebody else's quote. Now, this is an interesting one because we had somebody call this one out today, trading the breakout. Obviously, very similar to what's going on in the market right now. We have a big triple top up there. The stock showed some relative strength, did not pull back as hard as the market did in that period of time. I actually like when a stock pauses at a resistance level as opposed to exploding through resistance level after having rallied 5 to 6 or 7 days, because a lot of people say it broke out, but they don't take into consideration the stock was just up 10% before the breakout. So you're kind of buying it a little bit late. So from the equity side here, for me personally, these 2 days over here would have been the ideal time to have gotten into this trade. Now, it looks amazing today, but it was called out in the community today and would not have been an idea that I would have allowed somebody on my firm to allocate new positions to, because we are technically 1, 2, 3, 4, 5 days of higher highs already in this move. So I would be a little bit more inclined to be waiting for this stock to pause for what we call an optimal entry, where the risk reward kind of makes more sense. And one of the things we train everybody on is, if I'm about to hit that buy button, is the next likely move justifying the risk I need to take to start this trade? And in this particular instance here, because it's already 5 days into the rally, we're probably looking at a 1-to-1 risk reward, which doesn't make sense for a new initial entry. And I kind of think that's one of the things that a lot of people miss, is they find good ideas, but their timing from a risk reward perspective doesn't make sense. Buy it one day, moves one day in their favor, and then pulls back, stops them out, and then does exactly what they expected. So in this particular case, I'd be more inclined to be waiting for a pause, which is what we talked about in the pre-market game plan today.
Well, that makes perfect sense on the stock side. Obviously, it's had such a nice run. But on the option side, what's great about a trade like this is you can profit while you wait. So in other words, let's say, for instance, you expect some sort of a pullback to that area of support that you drew there. What I could go ahead and do is, if it depends, really, again, it depends on how aggressive you want to be. You can sell at the money calls currently where Meta's trading, and then simply buy an out of the money call on top of it at a higher strike price, creating a credit. Now, the implied volatility on Meta is fairly high. It's in the low 30s, which sometimes it could go as high as 50 or 60. But because volatility is elevated somewhat right now, you could probably get a pretty decent premium if you went ahead and sold at the money calls, or maybe slightly out of the money, maybe a couple of dollars above current price, just to give it a little bit of wiggle room, in case it does move a little bit higher on Monday morning. And then you could just go out about a week. You don't, with credit trades, what's great about them is you don't want to go out too far. You want to go out maybe a week or two, let that time decay work in your favor, and profit while you wait. So you wait for the pullback. It's called the bear call spread, where you sell a call and you buy a call on top at a higher strike price, receive the credit, wait for the pullback, and then you could turn around and go long. You could go long a position either in the stock market itself, or you could just go ahead and buy a long call option.
How much does the VIX volatility play into this right now? The fact that we're back at 16, which is kind of not really that volatile. I know we're starting to make a little bit higher highs here, but you mentioned quite often the difference between the environment to be initiating a credit spread versus a debit spread. What would you be thinking right now in general with the way the market just gapped up after yesterday's FOMC announcement?
Well, I think given the environment that we're in the election cycle, we're in the month of September still, even though the VIX has sold off a bit, I do anticipate a little bit more increased volatility in the next couple of weeks. Maybe not a big spike like we saw a month ago, but I think that could happen. So I am leaning more towards doing either debit trades that involve a two-leg strategy, which has some sort of credit component to it, or credit spreads when implied volatility on the underlying is fairly high. Now, with the case of Meta, not super high at 30%, usually above 50% is where I really want to step on the gas on the credit side and do more credit trades. That, 50, 60% is really when things get kind of interesting, where the premiums are juicy. But that being said, with Meta, since it's had such a rally, to just be able to do something while you're waiting for that pullback, even if it's a small premium, is the right thing to do. So it really kind of depends. But given the environment we're in, I prefer to have a little bit of a mix in my portfolio right now.
So kind of going off track just a little bit, you and I have both been saying for a while now, probably well over a month, that we thought 50 basis points would be aggressive by the Fed. It seems like the market is cheering that. We had a little bit of chaos right after the announcement. Huge reversal candle in most of the indexes the day of the announcement on Wednesday, which at this point is 2 days ago. And the market came back after 17 hours. It exploded in the other direction. What's your take on why that happened?
Yeah, I think that it's almost turning into a little bit of a sell the news event. There was that initial euphoria, obviously. I think, to be honest with you, it's very hard sometimes to tell who the buyers and who the sellers are. But I'm starting to feel that the buyers are kind of the FOMO crowd. The crowd that kind of like, wants to jump in at the end of the year or jump in after the news and kind of like the coast is clear, things are great. But then you got to ask yourself the question, what buyers are left at this point? And at this point, the answer is I'm not sure. If I was a big institution or a big bank, which makes up most of the volume on the New York Stock Exchange, I'm not going to be quick to buy things here. And what I do see institutions buying right now is gold and bonds. That's what they're buying in mass. So who's buying right now? I think it might be more of the retail crowd, which basically tends to be a little bit of the opposite of what's going on.
Yeah, there's a lot of fear of missing out. If you kind of read the comments on social media right now, everybody's talking about you have to get long now because the Fed stepped in and helped the market, so to speak.
Absolutely.
I think the big conversation right now, though, is it's off of inflation, and now it's about jobs, because you can say all you want about the economy, but if people aren't working, the economy's not going anywhere, and the jobs number is the big thing right now.
Absolutely. So that's that's my take on things. Absolutely.
All right, awesome, John. Thank you so much for your time today. These are kind of fun doing the recaps. Not recaps, different perspective stocks versus options. You can trade both of them, but it's a question of how.
Yeah, absolutely. What's great about what we do is we can look at things from different sides and always put really good trades together, given the circumstances. So it's awesome stuff.
Yep. All right. Thank you so much, John. Have a great weekend.
Have a great weekend as well, Pete. Take care.
Bye bye.